We have a great guest today here in a moment, Ms. Schneider, to give her take on what we've seen here just today, but really some of the larger themes that we teased out in our Charting Forward 2024 Market Outlook special from the end of last year. Before we bring Mish on, one quick announcement. Our mailbag is empty. We need more questions. We would love to hear from you. What are you running into as you've had some time over the holidays, as you're sort of setting your New Year's resolutions as an investor? How can we help you make better decisions using technical analysis and using the Stock Charts platform? Our email is thefinalbar@stockcharts.com. We're on X @finalbarsctv. And here on YouTube, of course, just drop a comment below the video that you're watching. We would love to hear from you. I hope to feature one of your questions in our next mailbag show. I want to welcome on today's guest, Ms. Schneider. Ms. is the Chief Strategist at marketgauge, coming to us from Santa Fe, New Mexico. Ms., it was such a pleasure to have you on our Market Outlook special at the end of last year, and thank you so much for joining us right after the holidays, and Happy New Year.
Happy New Year to you and to everybody at Stock Charts. It's been my extended family for quite a few years now.
Years ago at a money show, we met and did an initial interview, and it was so much fun, and I feel like we've smiled and laughed a lot in the years since that moment. So I hope 2024 brings more of those, and I appreciate you giving us some time, Mish. So let's talk through some of the charts. Obviously, a bit of a risk-off day today, but let's not draw too many long-term conclusions from the short-term data. We're starting with your chart of the Russell 2000. Help us put things into perspective. What are you thinking as you're sort of getting started in the first trading week here?
Well, two things I want to hit based on what you were talking about before I came on. One is the levels that you were mentioning in the S&P and the fact that we're in a January effect. So absolutely, that 4,600 level I think is super key. And it would not be the great surprise. Nothing would surprise me that we break back through 4,800 and continue to new highs, although that seems less likely. Or we break down under that 4,600 along with the 6-month calendar range reset, which we'll get a chance to talk about when we look at my charts, which will happen after the first 10 days, trading days of January. That's going to be so key because I think that's going to set us up for the next 6 months, whether the S&P 500 holds that 4,600 and continue to either chop around, like you say, or extend its rally, or it breaks down and we see 4,400, even possibility of 4,100. So what's so great in terms of technical analysis is you have these levels, the potential giant double top, but you also have tremendous support, and then you have the January calendar range. So I'm kind of in a wait and see, as I say, agnostic on where the next direction is going to be. I'm not in a big burning rush. The other thing I wanted to mention was that in terms of the NASDAQ and the growth stocks, the valuations got so lofty. They were at basically and beyond dot-com bubble levels. So to see a pullback there is not a great surprise. And wouldn't it be great if it was just so easy, oh yeah, rates are going down, just keep buying all the Magnificent Seven and everything else for that matter, and it's just going to be that easy to make money. No, it's not. This is not going to be the easiest year like it was the second half of last year. So that's kind of the backdrop I wanted to.
It's never as easy of a game as we want it to be, I feel like. But already I think this first trading of the day is sort of a good wake-up call, reminder to have good stop losses, good risk management in place, and kind of be ready for the unexpected. Can we get to the... Yeah, go ahead.
Yes, we'll get to that. But I mean, anecdotally, this is really interesting because last year was the year of the rabbit, right? And the expression that we used in the beginning of the year was you can't hunt with the hounds and run with the rabbit. But boy, was that ever the case, right? Because anybody that had their nose to the ground trying to find danger missed the race with the rabbit. And this year we have the year of the dragon, right? So the dragon, people think is such an auspicious animal, but in Chinese folklore, it can be the gate of heaven, but it could also be the gate of hell. And so my expression for this year is, if you can't take the heat, don't tickle the dragon. And I think that's really going to be a theme this year, which is as things get hot, the dragon will start to spew some fire. You have to be nimble. So let's talk about the Russell 2000 with that.
All right, here's your chart of the IWM. Talk us through what you're seeing here on this sort of initial pullback here at the beginning of the year.
Well, a couple of things. First of all, we did have a new 60-plus day high. That was last week, as you can see there. It was followed by an inside day, which made a lot of sense, and then a big down day right at the last day of the year with follow through today. So that's a classic new high reversal. It can yield a correction of anywhere between 5 and 10%. So that's something to look for, because if it turns out to be more like 10%, we're talking about 180, which is essentially where things broke out from. So that would be a good number to keep in mind. And it would certainly support this sort of reversal. It could stop at 5% too, which would be closer to 190. We know we're back down under 200. But when you have that kind of pattern, the important thing to remember is, yes, we can correct. We don't know how much. But B, the pattern gets negated if we take out that high. And so we're in sort of a chop zone right here. And people have to be a little bit cautious until it's clearer, and especially after everything that you mentioned before about some of the other areas. The second thing that is so interesting to look at on this chart is that green horizontal line right underneath all that price action after the big gap day. And there's a gap that's waiting to be filled potentially. That's the July 6-month calendar range high. And so you can see that we had at the end of the cycle in December, so it's not going to be as powerful as it said happened in July. And that's why I'm mentioning this now, because it could be very powerful depending on what happens in January. But it took it out, and now it's going to reset in just a few days, another 9 trading days from today. That's going to be, and that's an ACP plugin by me for a second, at Stock Charts. And that's going to be really important, because if we fail the 6-month calendar range high, and we break down under the 6-month calendar range low, as you can see where that blue triangle is back from September, it often really tells you that, we're due for a major correction. So I'm looking forward to that. The next thing to notice on that chart is the golden cross we got today. And that, people are shocked that the fact that the IWM has not been bullish, but it hasn't. It's been in an accumulation phase, and now it's getting bullish. But when you have bullish phase, I should say, but when you have price so far away from those moving averages can act as a magnet, which supports the case, obviously, for a potential another anywhere from, let's say, 5 to 7% correction from current levels. And then it also really shows you how pretty that 180 number is.
It's interesting, and not to steal too much thunder from Charting Forward, we had a really fun conversation with a couple other guest experts at the end of last year. And thanks again, Mish, for being a part of that. It was a lot of fun, but not to rehash everything we talked about, but we did talk a little bit about small caps, of course. Small cap is sort of large over small was one of the key themes through most of 2023 that just started to change at the end of the year, where small caps started to sort of re-exert some leadership. Do you think that was a taste of things to come? Do you think 2024 is a little more of a small over large type of year in some ways?
It's very possible, let's put it that way. But we can even go beyond that. And yes, Julius and I and you, we all talked about that, and I'm glad you brought that up. Really, in order for this rally to sustain this year, it does seem like we really have to count on those small caps to stay in the game. So whether they start to extend the rally beyond growth and become a theme, or whether they just stay in the game and continue to move up, which would make everything bullish, we don't know that yet. But regardless of what the narrative is, it's going to be all about small caps. And we start breaking down under that 180 level. I think it's going to be hard for anything to really hold its most recent gains.
All right. Another member of your modern family, the Granny Retail, the XRT. What's the take here?
Well, same kind of thing, right? So we had that new high. We had an inside day. So we had a little bit of a reversal there. If we take the current levels and we say maybe 5 to 10% correction from these levels, we're talking about maybe getting back as low as that 50-day moving average. This had a golden cross well before the IWM. Again, the 6-month calendar range, it broke through, and it had its sort of end of the range rally. We'll be keeping an eye on that. But what's also interesting is that we know, and this is kind of to the point of stables versus discretionary, regardless, we know that the granny has to stay also in the game. The consumer is a major reason why we saw the rallies that we saw from October into the end of the year. Consumers were far more frothy in terms of how much they spend for holidays, and also in terms of how much disposable income they have, and just the willingness to spend regardless of what's going on in the world, and particularly in this country. And so I think that in order for us to really see what happens in terms of the staples versus discretionary or the value versus the growth, we have to watch XRT because it's a really nice combination. And if we just move down to the leadership chart there, the other thing that's really nice, and this would be my modern family risk on environment, is the fact that it is outperforming the SPY. This is comparing it to the benchmark of the SPY. And look how long it was outperforming the SPY. It goes back to November, right before Black Friday and the Thanksgiving. So what does that tell you? Consumers led this rally. I mean, yes, we had nice rallies in Apple and NVIDIA and all that other stuff, but really the breadth of it had to come from this area. We want to keep seeing this outperform the SPY. And then finally, and probably what supports this little reversal that we've seen here in the price, is the mean reversion of the real motion. So this is the momentum indicator that we have. And you could see that once it broke down under that Bollinger Band on the top, that's a classic mean reversion. And so we're now really back into the support levels that we saw at around 70 when the price was 70. So that's my number, 70. If we hold 70, I'll be very happy. If we can hold 70, then I think, again, along with everything else we just talked about, we could see a little bit more of a deeper correction as we're going into the middle of January.
We only have about a minute left, but I'd love to hit on junk bonds. You often bring up the HYG, the JNK, those ETFs that track that crucial space for thinking about risk. What does the chart of high yield debt here tell you about market conditions overall?
Well, first of all, you can see that that too had sort of a reversal. And even though it cleared the resistance of what we saw in the beginning of 2023, if you go back to the highs that it had in 2021, 2022, got nowhere near there. So this whole area of high yield, high debt has underperformed a little bit, almost like a voice of reason, if you will, to lofty valuations. But the thing that I want to point out too is that if we look at the leadership here, it is underperforming the SPY, which means that people are starting to lose their appetite for risk, for high yield risk for sure. And it too had a mean reversion. So these are the kinds of things you want to see. You want to see the junk bonds it could go down basically back to around 74. That would also be about a 10% correction from current levels. But same thing like I'm saying, if you really want to be convinced that we can go much higher in the SPY, this again now will have to get through its most recent levels. 77.40 was kind of pivotal. Recent highs were closer to what, like 78, a little bit over 78. We have to get through that 78. If we do, then I guess everyone should get very, very bullish.
Certainly seems like a lot to think about. I appreciate you highlighting some of those individual levels, Mish. What a pleasure to see you. Happy New Year. Best to all the team at marketgauge. We'll talk to you again soon, all right?
Thank you so much, Dave. Happy New Year again.
That's Mish Schneider. Mish is the chief strategist at MarketGauge, coming to us from Santa Fe, New Mexico. Those indicators, by the way, we talked about, the 6-month range, leadership, real motion. These are all part of the ACP premium plugins from the folks at MarketGauge. Really thoughtful, really compelling. And if you go to our ACP platform, at the bottom right, you'll have the little plug. You can click on there to see the MarketGauge plugins. Check those out and see if they could add to your decision-making thoughts. Interesting when you hear Mish's take on it, right? Sort of that initial sell-off in the beginning of the year. What's interesting is a lot of these charts have plenty of room to have a healthy drawdown, but still be within a fairly constructive setup. And that's where I feel like I'm at right now. You're sort of coming off of pretty extended levels, but an uptrend can have plenty of drawdowns within that trend and still be overall pretty constructive. Great take there, as always, by Mish Schneider at MarketGauge. Folks, we got to wrap the show and go to the